Welcome to the Money RX for CRNAs podcast. I want to tell you about Jennifer. Jennifer is a CRNA. She worked for 25 years. She saved over $1 million in her 403B, and she did everything right. She maxed out her contributions every single year. She lived below her means. She should feel proud. But Jennifer made a $200,000 mistake, and she didn't even know it until she turned 65. When her required minimum distributions kicked in, plus her Social Security, she jumped from the 12% tax bracket straight into the 24% tax bracket. She's now paying over $40,000 a year in taxes. Taxes she could have avoided. Today we're going to show you how to avoid Jennifer's expensive mistake. We're going to talk about tax strategies that work specifically for nurses and CRNAs. And by the end of this episode, you'll have a roadmap to potentially save tens of thousands in retirement taxes. Most CRNAs face a very unique tax problem in retirement. You spent 20 or 30 years maxing out your 403B or your 401k contributions. You've got high Social Security benefits because you earned good money. And when you hit 73, your required minimum distributions start. Add that to Social Security and boom, you're in a higher tax bracket in retirement than you were when you were working. Let me give you some real numbers. CRNA couple with $2 million in their 403B accounts. That sounds great, right? By age 73, their required minimum distributions alone are $75,000 a year. Add their Social Security of maybe $5,000 a month, and they've jumped from the 12% tax bracket to the 22% or even 24% bracket. Now this is what I call the CRNA tax trap. You followed all the traditional advice. Defer taxes now, pay later. Well, guess what? Later is here, and it's very expensive. So what's the solution? It's called tax bracket filling. Instead of paying low taxes early in retirement and high taxes later, you smooth things out. You strategically fill up the lower tax brackets during your early retirement years. You need to think about your retirement money in 3 buckets. Bucket 1 is your tax-deferred money. That's your 403B, your 401k, your traditional IRA. Bucket 2 is your tax-free money. That's your Roth IRA, your Roth 403B. And bucket 3 is your taxable brokerage account. And this is the secret weapon most CRNAs don't use enough. Let me tell you about Tom and Lisa, both CRNAs. They retired at 60. They had $1.8 million in their 403B accounts and $400,000 in a taxable brokerage account. From age 60 to 67, they lived primarily off of their taxable account. So they took advantage of the 0% capital gains rate. They also converted $50,000 every year from their traditional accounts to Roth. What happened? They saved over $150,000 in lifetime taxes. Now that's real money. Money that stays in their family instead of going to the IRS. Let me explain how this 0% capital gains thing works. If you're married filing jointly, you can realize up to about $94,000 in capital gains and pay 0 federal tax. 0. This is perfect for early retirement years when you don't have other income coming in. Tom and Lisa needed about $80,000 a year to live. They sold some investments from their taxable account. Now, half of that money was their original investment. The other half was gains. They paid 0 federal income tax. Think about that. $80,000 of income, 0 taxes. But they didn't stop there. They also did Roth conversions. They converted $50,000 every year from their traditional IRA to their Roth IRA. This kept them in the 12% tax bracket. They were paying taxes on purpose, but they were paying them at a low rate instead of waiting and paying them at a high rate later. Now, once Tom and Lisa turned 67, they started taking Social Security. They've reduced their Roth conversions to about $30,000 a year. They were still filling up that 12% bracket, but they had to be more careful because Social Security income can push you into higher brackets. And this is where it gets a little more complex. Let's talk about asset location. Not asset allocation, asset location. This is about where you put your investments, not what investments you choose. In your tax-deferred accounts, your 403b, your 401k, put your bonds and REITs, because these generate income that gets taxed at regular rates anyways. In your taxable accounts, put your growth stocks and index funds. These are very tax efficient. They don't generate much income until you sell them. And in your Roth accounts, put your highest growth potential investments. These will never be taxed again. This simple strategy can save you thousands of dollars in what we call tax drag. Tax drag is when your investments are less efficient because of taxes. Now, if you're doing larger Roth conversions, you need to watch out for something called IRMA. That's the Medicare surcharge. If your income goes above certain thresholds, you pay higher Medicare premiums. For 2025, that's $106,000 for singles and $212,000 for married couples. The key is timing your conversions strategically. So what's your action plan? Think about retirement in 3 phases. Phase 1 is your early retirement years, before say age 65. Live primarily off your taxable accounts. Take advantage of that 0% capital gains rate. Start your Roth conversions. Delay Social Security if you can. Phase 2 is ages 65 to 73. Now you're getting Social Security. You can continue doing smaller Roth conversions, and you need to watch those Medicare income thresholds. You're preparing for Phase 3. Phase 3 starts at age 73. Your required minimum distributions begin. Now you're in spend down mode. You use your Roth accounts for discretionary spending. You focus on legacy planning for your family. And here are the biggest mistakes I see CRNAs make. Mistake number 1 is the set it and forget it approach. You max out your 403b or 401k for 25 years and never think about the tax consequences. Mistake number 2 is ignoring asset location. You put tax inefficient investments in your taxable accounts. Mistake number 3 is all or nothing thinking. You're either avoiding all taxes or you don't care about taxes. The smart approach is strategic tax planning. Mistake number 4 is not planning for required minimum distributions. You let your traditional accounts grow too big and miss conversion opportunities. Okay, so what should you do right now? First, calculate your tax diversification. How much do you have in each bucket? Tax-deferred, tax-free, and taxable. Second, model different withdrawal strategies. There's software available that can help with this, and your financial advisor should be able to help you think through this and model it out. Third, Evaluate your Roth conversion opportunities. Can you fill up a lower tax bracket? And fourth, consider getting professional help. A fee-only financial advisor who understands tax planning can often save you more than they cost, especially if you have a complex situation. Let's go back to Tom and Lisa for a minute. They didn't do this alone. They worked with someone who helped them model different scenarios. They looked at what would happen if they converted different amounts. They planned for different market conditions. They made sure their strategy made sense for their specific situations. The numbers matter. Before their strategy, they would have paid about $420,000 in lifetime taxes. After their strategy, they're paying about $295,000. That's a $125,000 savings. Plus, they have better legacy planning for their kids. Now, I want to be clear about something. The goal isn't to pay zero taxes. The goal is to pay the right amount of taxes at the right time. Sometimes it makes sense to pay taxes today to avoid paying higher taxes tomorrow. You also need to think about your state taxes. Everything I've talked about today is federal taxes. Your state might have different rules. Some states don't tax retirement income. Some states tax everything. This affects your strategy. And let me give you one more example of how powerful this can be. A CRNA couple, both 62, just retired. They have $800,000 in their 403B and $300,000 in a taxable account, and they're worried about taxes in retirement. They can live off of their taxable account from age 62 to 67. They can do $40,000 in Roth conversions every year, and they stay in the 12% tax bracket. They delay Social Security until 67. When they turn 67, they start Social Security. They reduce their conversions but continue the strategy. By the time they reach age 73 and required minimum distributions start, they've converted $200,000 to Roth. Their traditional account balance is smaller. Their required minimum distributions are smaller. They stay in lower tax brackets throughout retirement. So this isn't just about saving money. It's about peace of mind. It's about knowing you have a plan. It's about not worrying that you're going to outlive your money or pay too much in taxes. You worked hard for your money. You sacrificed. You worked long hours. You missed family events. You deserve to keep more of what you earned. You don't want to give it all to the IRS. Tax planning is a marathon, not a sprint. Small decisions will compound over decades. The earlier you start, the more you can save. But even if you're close to retirement, there are still strategies that can help. Professional guidance often pays for itself. A good advisor can help you model different scenarios. They can help you avoid costly mistakes. They can help you coordinate all of the moving pieces, your withdrawal strategy, your Social Security timing, your Medicare planning, your estate planning. And remember, you have 3 tax buckets: tax-deferred, tax-free, and taxable. The key is using them strategically. Don't put all of your eggs in one basket. Diversify your taxes just like you diversify your investments. Take advantage of 0% capital gains rates when you can. Consider Roth conversions during your gap years. Think about asset location. Plan for required minimum distributions. And watch out for Medicare surcharges. Most importantly, don't do this alone. Get help. Use software. Work with a professional. Your future self will thank you. So what's your next step? Start with a simple calculation. Look at your current tax diversification. How much do you have in each bucket? Are you too heavy in tax-deferred accounts? Do you need to build up your taxable accounts? Do you need to start Roth conversions? Model different withdrawal strategies. What happens if you retire at 60? What if you retire at 65? What if you delay Social Security? What if you do Roth conversions? What if you don't? The scenarios can be complex, but the principles are very simple. Smooth out your tax liability over time. Use all 3 tax buckets. Pay taxes strategically and get professional help when you need it. Don't make Jennifer's mistake. Don't let your tax-deferred accounts grow too big. Don't ignore the power of taxable accounts. And don't wait until it's too late to start planning. You've worked too hard to give it all to the IRS. You deserve to keep more of what you earned. You deserve to retire on your terms. You deserve peace of mind about your financial future. And that's what we're here for, to help you navigate these complex decisions, to help you build a plan that works for your specific situation, to help you retire with confidence and on your terms. Thanks for listening to this episode of the Money RX for CRNAs podcast. If this episode helped you, please subscribe and leave a review. Follow us on social media at Money RX for CRNAs, and join our CRNA Pulse newsletter for weekly tips and strategies. Until next time, stay well, stay intentional, and keep moving towards a future that's truly your own.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.